Okay, I think we're gonna start the class now. Good evening, everybody. For those of you that are just joining this class, my name is Akmo Bola Christopher. I'm your lead tax lecturer. I'm very sure many of you in this class today met my other colleague last week, which is Mr. Idris, and he must have taken you through some introductory aspect of taxation. Last week, we also met where we discussed basis of assessment. And I was able to tell you what we mean by tax year, which is the same thing as the calendar year. And I also told you that government runs their basis period from January to December of every year. So we also talked about what basis period means. I remember I told you that basis period is the definite period of time in which the income of the taxpayer will be assessed to tax. It's a period of time within which the income of the taxpayer, whether it is an individual or company, when their income will be subjected to tax, that is a period in which their income will be subjected to tax. For example, every company in Nigeria must also have an accounting year end where the company's income will be, where the matching and accurate concept will be used for the purpose of ascertaining whether the company really makes profit or not. So we talked about actual year basis in the last class. And I remember I told you an actual year basis period is a basis period that must have started and ended within the tax year. By implication, what that means is that your basis period must have started from the 1st of January of the calendar year and also end at the end of the year of that same calendar year. That is what we call an actual year basis. That's what we call an actual year basis. I'm trying to share my face so that you guys can see your lecture. Yeah. So we also talked about preceding year basis period. Your preceding year basis period, I told you, is a basis period that must have started and ended before the tax year, taking cognizance of the company's accounting year end. So when you look at that, for example, I told you it's a period that must have started and ended within the tax year, taking cognizance of the company's accounting year end. So take, for example, let's assume an accounting year end of the company is, let's assume an accounting year of the company is 30/6 annually. And I remember, when you say a preceding year basis period, it's actually a basis period that must have started and ended before the tax year, taking cognizance of the accounting year of the company. So in this situation, we are assuming that the company accounting year end is 30/6 annually. So you remember we said it must have started and ended before the tax year. Therefore, I am going to have from 1/7/2019 to 30/6/2020 for a 2021 tax year. So for a 2022 tax year too, I'm going to have 1/7/2020 to 30/6/2021. When you look at what we have done here, you would actually notice that the basis period had actually commenced and ended before the tax year. Our tax year is 2021, and our basis period in this scenario had started and ended before the tax year. So that is what we call a preceding year basis period. So we also talked about normal basis period in our last class, where we said normal basis period has the following characteristics. Number one is that the basis period must not be more than or less than 12 months. And when you look at what we have here, you will notice that our basis period was not less than or more than 12 months. And the number two is that the basis period must commence immediately after the end of the previous period. So if you look at this and these two, you will notice that at this period ended, this period commenced. So that means it's a basis period that must have commenced immediately after the end of the prior one. And the third characteristic of that is that we said it must be on preceding year basis. That is what makes a basis period a normal basis period. Now, having said that, we also talked about abnormal situation in our computation. So there could be a situation whereby the tax payer witness an abnormal situation. And when does this occur? An abnormal situation occur in a situation where a company actually just commenced operation or ceased operation. In that scenario, that means it's a possibility that the basis period could be more than or less than the 12 months, and therefore it disqualifies it from a normal basis. And in my last class with you, I also told you that the reason for the introduction of Finance Act 2020 and 2019 was for the purpose of eliminating any form of complexity in the assessment of companies to tax, especially when the company is just commencing operation, and at the same time to also eliminate any form of overlapping of basis period. Now, we move straight to where a company commences operation. And I was able to explain to you that when you are computing your tax liability, when you see period two means a period that is either less than or more than 12 months. Where you see year ended, it means a period that is equal to 12 months. That is what year ended means. Having said that, we quickly went straight to the tax implication of a company that is just commencing operation. We said for a company that is commencing operation, 3 years are statutory. The first tax year, the second tax year, and the third tax year. Now, for the first tax year, we said a company that is just commencing operation in the first tax year shall be assessed to tax from the date of the commencement of the business to the end of the business life. Sorry, to the end of the first accounting year end. So by implication, let's assume that a company commences operation 1/7/2020. And let us also assume that the accounting year end of the company is 30th 9 annually. So if we are going to assess this company to tax in their first accounting year, we would have said from 1/7/2020 to 30th 9 2020, meaning that the company is assessed to tax from the date of commencement to the end of their first accounting year end. We move to the second tax year, where we said, okay, I put an illustration here. Okay, thankfully, it's the same illustration I've just said. So we said, assume Adunu Limited commenced business on 1st July 2020 and make sure its account to 30th September annually. So what we eventually said is that the company will be assessed to tax from the date of commencement to the end of the first accounting year end. Note again that under Finance Act, the Tax Act recognizes only preceding year basis. Therefore, this company would be assessed to preceding year basis, whether they are just commencing operations or not. We said the second tax year will be assessed to tax from the day immediately after the end of the first accounting year end to the end of the second accounting year end. While the third tax year would be from the day immediately after the end of the second accounting year end to the end of the third accounting year end. We also talked about the fourth and subsequent years. We said for the fourth and subsequent years, the company shall be assessed to tax on a preceding year basis. That was what we discussed in our last class. We also moved straight to cessation of business. We said when a company ceases operation, there could be various reasons why companies will cease operation. One of the reasons for the cessation of business could be as a result of the fact that there is a court order for the company to cease operation. There could be government legislation. There could be natural disaster. You remember during COVID, there are a lot of businesses that could not go ahead again. They had to cease operations. And I also told you, note that when the company stopped temporarily, maybe due to industrial strike action, maybe due to maybe they are unable to, maybe they have problem with their tools, that they are using, it does not mean that that company has ceased operation. Therefore, such a company, you are not going to apply cessation rule to that company. However, when a company stops production permanently, I put it here, that therefore, for tax purpose, the only period recognized is a period of permanent stoppage. Once the company stops operation permanently, therefore, such a company will be affected by the Tax Act. So we move on straight to how do you assess a company that is ceasing operation? I said for a company that is ceasing operation, such a company shall be assessed with tax from the beginning of the accounting period to the end of the accounting, so to the end of the business life, or to the date of cessation. And also, this company must also file their tax return and pay all necessary tax liability within 6 months. We also talked about post-cessation income and expenses. Post-cessation income and expenses, that is receipt and payment after the date of cessation. We said when a company ceases operation and they make income after the cessation of the business, or they incur additional expenses, such expenses will be deemed to have been incurred on the day the company ceased operation. Again, if they make an income, such income will be deemed to have been made on the day they ceased operation. And therefore, what is the procedure? What you need to do there is to adjust the terminal profits. We did that in our last class, and hopefully, I believe every one of us in this class understands that. The next one I will discuss in our last class, which we're going to revisit again today, is the cessation of business. And thereafter, today, we would also move straight to our topic for today. Okay, we move ahead. Change of accounting dates. I'm going to take my time to re-explain this to you again, because this has been one of the areas that examiner has tested in the past, and they might still also test it. Also, don't forget that for commencement of trade, examiner severally have also tested it before. They can still test it. We are still going to see some other scenarios for companies that are just commenced operation. But this is just a preliminary explanation to our class. Okay, we move on again to change of accounting dates. What do we mean by change of accounting dates? We said when a company has been operating on a particular accounting date, take for example, such a company, let's say the company has been operating their year end to be 30th September annually. But all of a sudden, this company decides to change the account to maybe December 31st. Now, such a company, we can say the company has changed its accounting date from the known date to the new date. So the practice of the tax authority is to assess the company on these two different accounts of that is the old accounting dates and the new accounting dates, to ascertain whether the company has made a significant profit. In that regard, because the tax authority wants to maximize return, the tax authority would only choose the one that will be of beneficial to the tax authority in terms of the higher returns between the old accounting dates and the new accounting dates. Now, what are the reasons why company will change their accounting dates? We have talked about this in our last class, but I'm going to take it little by little because of those of you that we are just joining. So we said number one, to obey government legislation or directive. That's number one. I cited an example last class. During 2005 bank recapitalization, one of the things that occurred then that all banks in Nigeria before this period were preparing the accounts on a different date. But when the government intervened, that is through the Central Bank of Nigeria, they directed that all banks should adopt the same accounting year end. And effective from 2005, all banks in Nigeria adopted the same accounting year end. Okay, and by implication, that means government directive has been what the companies had to follow. So government directives could be one of the reasons why tax or why the company could change their accounting dates. Having said that, we also go straight to the next one, which is to execute new tax policy. Recently, you could see that government have been introducing a lot of tax policy in form of addendum to the current tax act by introducing finance act. As we speak, from 2019 till date, we had had 4 finance acts. We have 2019, 2020, 2021, and 2023. So that is to tell you that government of the day can decide to change their tax policy. So if tax policy had changed, that means there's every possibility that the accounting of the company might also change. Having said that, again, to use consolidation of financial statements is another reason why company might decide to change their accounting dates. You remember in your consolidated financial statements, 2 companies, that is the parent company and the subsidiary, might not be able to operate if they operate different accounting year end. Therefore, to be able to align very well, they must operate the same accounting year end. Therefore, we say because of that, the subsidiary will need to change their accounting dates. We also said to synchronize the accounting dates of subsidiary with the holding company, which is almost the same thing as what I've said there. We've talked about where there is a merger of company or acquisition of a company, and I also gave an exact definition of what the merger means. It said merger would be when 2 companies that have different identity come together for synergistic reasons. We'll now move to the tax procedure. What is the procedure? Before the procedure, what are the considerations of the tax authority before a change of accounting dates could be granted? Number 1 is that the taxpayer or the person, the company that wants to change the accounting date must request in writing to the tax authority before such a change could be granted. That's number 1. Number 2 is that the tax authority wants to see the reason for your change. If the reason is to evade tax, such will not be granted. That's number 2. Number 3 is that we want to see the dates involved. If the dates involved include date of permanency, such a change will not be accepted. When I say date of permanency, that is the year of cessation. If it includes the year of cessation, it should not be granted. So that is that. What are the procedures? Excuse me, guys. What are the procedures for computation? We said number 1 is that the taxpayer must first determine the first year of change. You, as a person preparing the tax liability now, you must determine the first year of change. We said, let's assume in this scenario, 2020 was the first year of change. You must determine the first year of change. After the determination of the first year of change, you must also determine 2 years after the year of change. In this situation, we say, let's assume it is 2020 and 2022. You determine the 2 years after the year of change. Number 3 is that you compute the assessable profit for the 3 years that you have identified above for the old accounting dates. You also do the same thing for the new accounting dates, and you add up separately. You will now select the higher of the 2, that is the ones that you have added up separately. You select the higher of the 2, and you make recommendation to the tax authority to assess the taxpayer on the higher of the 2. Now, how do you determine first year of change. Now, when you look at this scenario, look at it. The company has been preparing the account to end 30/6 annually. But all of a sudden, they change the account to 31st December annually. Now, when you look at this company has not changed in 2021. I'll tell you the reason why they did not change in 2021. But let's look at the second scenario. In the second scenario, look at this. The company accounting year is 30/9 annually. But all of a sudden, they changed to 31st December annually. So what can we say about this? When you look at these dates, we can actually say that this company has changed in 2022. Meanwhile, you cannot say the same thing for this guy, that this company has changed in 2021. This company did not change in 2021. The company only changed in 2022. But how do you determine the year in which the company changed? Let's go. Now, the difference between the old accounting dates in terms of the months and the new accounting dates months must not be less than 12 months. Mustn't be less than 12 months. So, but in this scenario, you notice that it is less than 12 months. Therefore, the company had not changed in 2021. Rather, the company has changed in 2022. We move on to this one. Look at it. In year 2021, that is 30/9, 2021, and period to 31st December 2021. When you look at the two, you will notice that the difference between the old accounting dates and the new accounting dates was more than 12 months. Therefore, we can conveniently say this company has changed in 2022. So, for now, if you have any question with regards to this, kindly ask your question. Judith, any question? Prosper, any question? Fidelis, any question?
No question from my end, sir.
Okay, go ahead.
No, I said no question from my end.
No question, okay. All right, we can now move ahead. Thank you. So, let's look at this illustration. This class is being recorded. We are still going to forward the recording to you again. So, be rest assured we are going to get the recording. So, the next one is for us to look at the illustration. Standard Trust Bank PLC, a leading financial institution in Nigeria, decided to change its accounting dates due to government policy that stipulate that all banks must have a uniform accounting date. The following results was taken from the books of the company. Year ended 31st March 2024. Year ended 31st March 2025. Year ended 31st March 2026. And the period to 31st December 2027. And year ended 31st December 2028. Required compute the assessable profits for all the tax year and give appropriate recommendation. Okay, how do we go about that? The first thing that we need to identify is the year of change. When did this company change? This company, as I've explained to you before, changed in 2027. This company changed in 2027. And when you look at the number of days, the difference between this period, and this period, you know that it's more than 12 months. Therefore, we can say the company change in 2027. Abi? Now, since the company changed in 2027, that means we have identified the first year of change. We have identified the first year of change. We also need to identify the 2 years after the year of change. That is 2028, 2029. Okay? So I am now going to assess them to tax on 2 different bases. The first basis is the old accounting year basis, and the second basis is the new accounting year basis. And I'll use preceding year basis for the 2. So let's go. I told you that we have 2027 to 2029 year of assessments. So the old accounting date of this company was 31st December annually. So 31st March annually. So in 2027, I will have once for 2025 to 31st 3, 2026 as my basis period on preceding year basis. In 2028, I will have 1 for 2026 to 31st March 2027, which should be assessed to tax in 2028. 2029, I will have 1 for 2027 to 31st March 2028. I'll come to my new accounting date. My new accounting date is 31st December annually. 31st December annually. Therefore, I need to also say I will assess that new date to tax using the preceding year basis also, which is going to be 1/1/2026 to 31st December 2026, 1/1/2027 to 31st December 2027, 1/1/2028 to 31st December 2028. That is that. But we also need to allocate profits. So we'll come here. So when you look at this, I have analyzed the profits that we have. These profits must have started from, let me take my pen. This period must have started from 1/4/2023. This also must have started from 1/4/2024. This period also must have started from 1/4/2025. This period must have started from 1/1/2027. This period must have started from 1/1/2028. If you look at this one, this is 12 months. This is also 12 months. But this is more than 12 months. That is from 1/4/2025 to 31st March. Oh, this is also 12 months. But this one is not 12 months. This is supposed to be 1/4/2026. So ended as we now need to use this to allocate our profits. So let's go. So when you look at this, what I wrote down there the other time is the same thing I have here. I have analyzed it here. Okay, so this is the analysis of our profits. So I'll come back to my table that I've already identified the basis period. In this my table, I have 1/4/2025 to 31st/3/2026. I'll come back to my analysis of profits. This my analysis of profits is what is the profit the examiner gives to me. This is what the examiner gives to me. And when you look at this guy, this one, and what we have been able to write from our principle that we have learned, you will notice that this and this is the same. They are the same. By implication, what that means is that it coincides. I'll just take the profits in front of it and I'll bring it here. The next one is 1/4/2026 to 31st/3/2027. So if I come here, 1/4/2026 to 31st/3/2027, where can we see it in this our analysis of profit? We can see that period here. But the entire number of months here is 21. So I need 12/21 multiplied by 1.7 million. So I will have 971,429. The next one is this. I need this. I need 1/4/2027 to 31st/3/2028. Where can I get it? When you look at this entire period, 1/4/2026 to 31st/12/2027, we can actually see in this period, we can see 1/4/2027 to 31st/12/27. Isn't it? We can see that. But we need more than that. But let's take that one first. So that means I'm going to have that period is 9 months. That is from 1/4/2027 to 31st/12/2027 is 9 months. I'll say 9/21 multiplied by 1/7. But that is not enough. We still need from 1/1/2028 to 31st/3/2028. That will now be taken from here. You can see this one. So that will now be 3/12 multiplied by 700,000. So whatever we add it together, and that's what made up this number. The calculation is actually here. So this is a calculation of everything. I've made it easier here. This is a calculation of everything that you need. So that is that for the old accounting dates. We are also going to do the same thing for new accounting dates. In my new accounting dates, I need 1/1/2026 to 31st/12/2026. Where can I see that? I can see sum in this first period, I need 1/1/2026. I can see one from this period, I can see 1/1/2026 to 31st 3/2026. That will be 3/12 multiplied by 1 million. Plus, I still need from 1/4/26 to 31st 12/26. Abi, that is 9 months. That will be 9/21 multiplied by 1.7. So whatever we have is what gives us this number. The next one, we need 1/1/2027 to 31st 2027. That one is inside this place. We need 1/1/2027. We need 1/1/2027. If you look at this one, you will see 1/1/2027 inside to 31st 12/2027. That means I will say 12/21 multiplied by 1.7 million. Whatever we have is what gives us this. The next one is 1/1/2028. No calculation is required. Look at this guy and this. Sorry. And this one. You will notice that this and this are the same. So I'll just pick the figure in front. So at the end of the day, what you are expected to do is to add the new accounting dates and the old accounting date together like this to get your answer. So, boss, the tax authority has responsibility of assessing the taxpayer to tax on the higher of the two. Therefore, the tax authority will assess the taxpayer on the old accounting day because it gives the higher number that is required. So the taxpayer will be assessed the tax on this. Any question? Okay. I want to assume every one of us understands that. Then we now move on to the next topic for today. So,
sorry, sir. I have a question, sir.
Go ahead.
Good evening. So, good evening, everyone. My question is relating to the three subtopics you've taught us so far: commencement rule, change of accounting date, and cessation rule. So, yes, I know the new Finance Act, according to what you explained in the last class, has revised some of the provisions regarding cessation, change of accounting dates, and commencement rule. So, if we have a question, I'm just curious, and I want to be sure of my position. So, if you have a question saying, for instance, a business commenced accounting operations in 2014 and blah blah blah, they have their accessible profits. Are we, based on that date, are we going to use the new Finance Act, that's the new provision of the commencement rule, to solve such question, or we should solve such question using the old rule based on that particular date, which is 2014. I don't know if you get my question, sir.
Your question was gotten correct. We are not going to use the old rule any longer. Old rules are not applicable again. So we are going to use the new rule. Anything we are teaching you here is the new rule. The new rule is going to be applicable to your solution. However, if you look at the past question, from 2021 going forward, when it relates to basis period, the examiner made sure that, excuse me, okay, as I was saying, the examiner made sure that all the questions they have been testing is related to the new Finance Act, and that is what the examiner has been testing. So recently, one of the things I've had cause to discuss with the examiner is the issue of the fact that they stopped testing petroleum profit tax, okay? And petroleum profit tax is still in application. It's still in existence in Nigeria, even though we now have PIA, but petroleum profit tax is still in existence. So for now, the examiner had not really come out with the aspect they are going to be testing on that. But from 2021 upward, we noticed that the examiner, 2022 rather, examiner has been testing questions from the PIA. Okay, so what we are trying to say here is that any law that is no longer relevant or that is no longer in existence, the examiner will not test it going forward. It should not be tested.
Okay, thank you, sir. Thank you, sir.
Yeah, any other question before we go to the next topic for today? Okay, in the absence of none, there won't be, we'll stop this topic now to the next topic that we need to do. Okay, today's topic is loss relief. Today's topic is loss relief. I don't know if every one of us in this class can see my screen.
Yes, yes,
Yes,
sir.
you can. So, good. So when you talk about loss, for example, what is loss? Loss will occur in a situation whereby the total profit of the company is not able to cover the expenses of the company. So in that situation, loss will occur. By implication, what I am trying to say here is that where a company is unable to cover its allowable expenses, then there is loss. Loss will occur in that situation. So, and there is a provision in the Act that when a company or an individual makes loss, such a company has rights under the tax law to relieve the loss indefinitely. Such a company has rights under the tax law to relieve the loss indefinitely. Before 2007, before 2019 Finance Act, it is not all companies that has right to relieve their losses against their profits indefinitely. Insurance company was exempted from this provision. By implication, that means insurance companies can only carry their losses forward for a maximum period of 4 years, after which, if they are unable to recover their losses, such would not be allowable going forward. But with effect from 2019 Finance Act, that was effectively taken out from the act. Therefore, the taxpayer, whether an insurance company or not, can now carry their losses forward indefinitely. So basically, I'm still going to forward this material to you. Sorry that I've not forwarded it before now. Basically, we have two types of loss relief. We have the carry forward loss relief and the current year loss relief. We are going to be looking at the two and what are the implications of the two. What are the characteristics of the two? What makes a carry forward loss relief different from a current year loss relief? We are going to be looking at it as we move ahead. Now, we'll go straight to the carry forward loss relief. Now, what is carry forward loss relief? Carry forward loss relief has the following characteristics, because that is the only way you can define or say something about carry forward loss relief. Now, for example, when you're talking about carry forward loss relief, this type of relief is granted to the taxpayer automatically. That is, irrespective of the situation, the taxpayer will be granted automatic relief. Okay? Will be granted automatic relief. The taxpayer will be granted automatic relief. That is, no written application is required by the taxpayer. They don't require any written application for this kind of loss to be granted, because the loss is granted automatically, irrespective of whether the taxpayer applies or not. It is going to be granted automatically. Having said that, we move on to the next one. The next one is that the loss of a source can be carried forward against future losses, future profits from the same source only. That is, there is every possibility that a company has two sources of income. Take, for example, an insurance company that operates life assurance business and non-life. So the profit from a non-life and a life business, you cannot take advantage of either of the two when one makes loss and the other one makes profit. So what we are trying to say here is that the loss of a source cannot be relieved against income from the other sources. Okay? It cannot be relieved against income from the other sources. By implication, that means you can only relieve the loss of a particular source from the same source of the loss. So that means if for example, in an insurance company that operates both life and non-life, in the life business, if they make loss in the life business, you cannot take advantage of non-life. So you have to wait till life business makes profit before you can now take advantage of that. Do you understand me? That is that. So we move on to the next one. It is granted to all kinds of businesses, whether trading, manufacturing, or allied business. The next one is that the loss can be granted indefinitely. Indefinitely. However, for individual, losses are not granted indefinitely. We are not doing individual in this class. We are only doing corporate tax. We are not doing personal income tax. So we are not going to be dwelling more on personal income tax. So we are saying that this kind of loss is carried forward indefinitely, except for an individual where it still limits it to 4 years. The next one, the relief is applied on the preceding year basis. We move on to the current year loss relief. This kind of loss is not granted automatically. Unlike a carry forward loss relief that you grant it automatically, this kind of loss is not granted automatically. The loss of an individual, it is only granted to individual, unlike carry forward loss relief that is granted to both individual and company. This one, it is only to individual. Next, the most important characteristics of this is that the loss of a source can be carried forward against, can be relieved against income from all other sources of the taxpayer. So what we are trying to say here is that if they make loss from a particular source, you can relieve such a loss from all other sources of their income. So let's go ahead to look at the applicability of this carry forward loss relief. So I said, assuming Insert Limited in 2006 tax year incurred a loss of 40 million, but made a profit of 5.5 million in 2017 tax year. Such a loss can be relieved from 2017 tax year, and any relief portion can be carried forward to 2028 till the loss is fully recovered. It should be noted that the loss can only be relieved from the same line of business, as the Tax Act does not allow for relieving such loss from other line of business, especially where the company is a group or the company operates a composite insurance business. That is combination of both life and non-life. The next one is Mr. James. Assuming Mr. James, this is under current year loss relief. Assuming Mr. James in 2015 year of assessment incurred a loss of 15 million from his transport business, but made a profit of 20 million, 2 million from Gary Professional Service, and 5 million from his hairdressing shop in the same year of assessment. The law allows him to utilize the 7 million profit made from the other sources of income to relieve the loss incurred from transport business for that same year. Remember, this guy made a loss of 15 million in this particular year, but has profit from all other sources. That means he can take advantage of the other sources. But if he's unable to take advantage of the other sources in the year in which the loss occurred, you cannot take advantage of the loss, the profit of the source again. You have to go to the source of the loss. So that is what that one is saying. So I have put a summary here between carry forward and current year loss relief for you to look at. Now, Finance Act and loss relief at commencement. Now, for loss relief during commencement, for now, there used to be overlapping of basis period, which usually makes the loss that a company incurs to be accumulated or to be accumulative, right? Now, because of this accumulation of losses, the Finance Act that has come has eliminated any form of overlapping of basis period. Therefore, losses do not accumulate any longer. Losses do not accumulate any longer because Finance Act has come to eliminate any form of losses that the taxpayer could have. Sorry, any form of overlapping. So because there is no more overlapping of basis period, losses during commencement will not also accumulate. Now, when you talk about priority of loss, loss has priority over capital allowance. Loss of a current period has priority over the subsequent period. So if a loss is made in this current year, for example, and another loss is made in the subsequent year, in terms of you relieving the loss, you must first relieve the loss that you incurred in the first instance, or before you relieve the subsequent ones. By implication, it means first in, first out. The first loss that comes in is the one that you have first going to relieve before you relieve the other losses. Okay. And I have also said that loss has priority over capital allowance. So where you have capital allowance and you have loss to claim, loss must be first relieved before you talk about capital allowance. Where the amount available after loss has been relieved against assessable profit is not enough to cover capital allowance for that year, the maximum capital allowance to recoup for that year shall be available balance after the loss has been fully relieved. This is what we are trying to say. If, for example, you have relieved your loss and you also have capital allowance to relieve in that particular year, the maximum loss that the maximum capital allowance that you can take is the balance between the assessable profit and the loss. Okay, you cannot take more than that. You cannot first take capital allowance before you take loss. We have said this. Note again that capital allowance is also restricted to 66 to third of assessable profits in any year of assessment. And this is only for trading companies. There are exemptions for agricultural businesses and manufacturing business. So that is that. Now, carry backward of loss on cessation. There is no provision under the tax law for the taxpayer to carry backward their losses when they cease operation and they have an unrelieved losses. So therefore, they cannot carry back their losses. But for capital allowance, you can carry backward capital allowance. So let's look at an illustration. Kule, a sole trader, commenced business at Lakwe on 1st March 2016 and chooses 31st May every year as its permanent accounting date. The adjusted profits / loss of the company or of the business for the year, first few years of trading are detailed below. Period 2, they had loss of 1,289,400. Year ended 31st May 2018, profit of 545,205. The next year they have profit of 210,945. The last one they have profit of 106,174. You are required to compute the total income of the taxpayer. How do we go about this? Now, the costing is also a commencement question. Even though the company is just commencing operation, but in this scenario, the company made loss. Because this company made loss, they are also going to be what? Assessed using the commencement rule. And you remember, when a company makes a loss, such a company shall be assessed with tax from the date of commencement to the end of the first accounting year. Now, in this scenario, when did the company commence operation? In this scenario, this company commenced operation on 1/3/2016. Okay? Commenced operation on 1/3/2016. So when you want to assess this company tax, your basis period will be 1/3/2016 to what is the accounting year of this company? The accounting year of this company is 31st May. Can you move back, please? 31st May annually. Therefore, I am going to say, if I'm assessing this company tax in the first year, it is going to be from 1/3/2016 to 31st May 2016. You remember, we said during the first year of assessment, the company will be assessed with tax from the date of commencement to the end of the first accounting year end. So the end of the first accounting year in this situation will be 31st May 2016. when you also analyze this profit, you remember I told you need to always analyze profits. If I'm analyzing this, it should be 1/3/2016. That is from when they commenced to this date. What will be the next one? It should be a day immediately after this guy, a day immediately after the end of the first one, which should be 1/6/2017. The next one will be a day immediately after this, should be 1/6/2018. The next one will be a day immediately after this, which should be 1/6/2019. So, if that is the case, I can now go straight to my computation. Now, you also remember in our last class, I told you that Finance Act is based on preceding year basis. Finance Act is based on preceding year basis. Okay? So, by implication, everything that we're going to be doing will be based on preceding year basis. So, let's start. In the first year, the company will be able to pass from the date of commencement 1/3/2016 to the end of the company accounting year, which is 31st May 2016. So, and when you look at the profit, the entire profit we have here is 15 months. The entire profit we have here is 15 months. The one we have here is 12 months, 12 months, and 12 months. So, that means in my first year that I have from 1/3/2016 to 31st/5/2016, how many months is that? That will be March, April, May. That is 3 of 15. So I am going to say 3 divided by 15 multiplied by the loss we have, which will be 257,880. We carry forward to the next one. In the second accounting year, you remember, we said the company will be assessed with tax from the date of commencement, from a day immediately after the end of the first accounting year end, that is.
Sir, how do we get the loss, please? Sorry.
Okay, no problem. So this is how we got the loss. Look at the question. The question is a loss. This is.
Yes, I saw it.
Okay.
It's indicated.
Okay. Yeah. I'm going to forward this material after this class. This class will end by 10 today by the grace of God. So, as I was saying, I said we now have from the second year, it is going to be from a day immediately after the end of the first accounting year end, which will be 1/6/2016, to the end of the second accounting year, which will be 31st May 2017. Therefore, we can now reasonably say that that is 12 months. If you go back to our analysis the other time, you remember I told you that this period is 15 months. Out of these 15 months, we need 1/6/2016 to 31st/5/2016. That is 12 months. So I'll just say 12 over 15 multiplied by the loss. I will have this number. You will notice something. What you will notice here is that the loss is not more than the actual loss incurred. By implication, it means there is no accumulation of losses. And by implication, because there is no overlapping of basis period, there is no also accumulation of losses. 2019. In 2019, these guys made profits. There was profit in 2019. profit of 500 and coming 545. That was the profit we made.
Can I ask?
Go ahead.
Okay, in other words, the Finance Act of 2020 equally help in this topic by helping us not to accumulate losses too. So did you hear what I said?
I heard it clearly. Yes, we are not accumulating losses. Do you understand? So
Yes,
Finance
as a
Act,
result of the Finance Act, yeah. Okay.
before now, we used to accumulate losses. But Finance Act has come to eliminate any form of loss accumulation. We don't accumulate losses again. In the old tax law, because of overlapping of base period, there could have been a kind of accumulation of losses. But for this one, there is nothing like that. So,
Sorry, sir. When you mean accumulation of losses, what does it imply, sir?
okay, let me show you an example. Let us assume that this question, we want to use old tax law to solve this problem. You remember in the old tax law, when a company commences operation, the company shall be assessed with tax from the date of commencement to the end of the account, to the end of the year. So from 1/3/2016 to 31/12/2016. Abi, in the second tax year, we would have said from the date of commencement again to first 12 months. The third tax year, we will say on preceding year basis. That will be from 1/6/2016 to 31/5/2016. So if I want to calculate my loss, the first loss will be from 1/3/2016 to 31/12/2016. How many months is this? I'll say March, April, May, June, July, August, September, October, November, December. 10 months. I'll say 10/15. Let's assume this number that we're given as loss is 15 so that it should be easier for me to calculate. 15 million. Abi? So I will have the first profit, the first loss that we have will be 15 million. Sorry, will be 10 million rather. Sorry. That is 10 over that. Let's say 30 million. Let's call this one 30 million. So that we will not be getting it wrong. So let's assume this one is 30 million. So if I say this, I will have 20 million loss in the first year. In the second year, I'm also going to have from 1/3/2016 to 28/2/2017. That is 12 months. I'll say 12 over 15 multiplied by 30 million loss. I will have 24 million. Isn't it? I will have 24 million. I will add down 24 million again, making 44 million. I'll carry 44 million forward in the second year. In the third year, I'll come again. I'll say I need from 1/6/2016 to 31/5/2016. That is 12 months. 12 again, 12 over 15 multiplied by 30 million. I will also have 24 million. So 44 million that I'm carrying forward, that I bring forward in the third year. My current loss for that year, current loss is 24 million. If I add it together, I will have 68 million loss. That's accumulation of losses. Okay? But how much was the loss that was incurred? The loss incurred that generated this 68 million was only 30 million. So in the old tax law, we say the loss at the end of the third tax year will be restricted to the actual loss incurred, which is the 30 million. We will now restrict it to this 30 million. That was what the old tax law said. But in the new tax law, the new tax law eliminates any form of overlapping. In the new tax law, what I would have just done is that I would just say in the first period, I'm erasing this. So in the new tax law, we are still assuming the same thing, 30 million as loss. So you remember that was the new tax law says from the date of commencement to the end of the first accounting period, which is this period, which is 3/15 multiplied by 30 million. And we have 6 million. In the second year, and we have, you remember the law says a day immediately after the end of the first accounting year end to the end of the second accounting year end, which will be 1/6 rather 2016 to 31/5/2016. That is 12/15 multiplied by 30 million. And we have 24 million. If I add these two together, is 30 million. Unlike that other one, you can see the difference. So Finance Act has eliminated any form of overlapping of base period. There is no more overlapping of base period. That was why we don't have it. That's why we have it this way. So we move on. So these are laws that we made. This value was the loss that was made, and the loss will be carried forward to the subsequent year. So in this current year, we made profit of 545, and we had a loss of 1,289,000. So that loss will be relieved against this our income. Therefore, we have this relieved against this. At the end of the day, we have no profit to carry forward, but we still carry the balance of the loss forward to the next year. In the next year, we made a profit of this 210, but we have a loss that we have brought forward from the last year. We also relieve it against the loss. So we have this balance to be carried forward. In the next year, we made a profit of 106,174. So we relieve it against the loss again, the loss that we brought forward, to have a carry forward loss. And that is how to treat loss relief. Any question? Any question? Okay. This is where we are going to end the class today, if there is no question.
Sorry, sir, are we going to solve more questions on this topic for next class?
We are not solving any other question on this one until we move to when we get to company's income tax, we are still going to see loss relief situation. This is just to lay a foundation to how to do loss relief. If you want us to do more questions, we can go ahead and look at the illustration number 2.
I wouldn't mind.
Okay. So let's look at illustration number 2. Okay, Owawa is a sole trader with a registered business as Gobe Enterprise. He commenced business on 1st of August 2018. The adjusted profit and loss of the company for the 3 years are given below. period to September 2019, 1.9 million loss. Year ended, 1.2 million profit. Year ended 2021, 725 profits. Now you are given capital allowance. Capital allowance claimed and granted for the year of assessment are as follows. You are now required to compute the total income of this enterprise for the first 5 years. Let's go ahead. You remember, again, when a company commences operation, such a company will be assessed tax from the date of commencement to the end of the first accounting year, right? So this company commenced 1st of August 2018, right? So if I'm going to write the first accounting year end, I'll say 1/8/2018 to 30/9/2018, right? So for the second year, I will say 1/10/2018 to 30/9/2019. The third year, I will say 1/10/2019 to 30/9/2020. The fourth year, I will say 1/10/2020 to 30/9/2021. 1, 2, 3, 4. Okay, first 4 years. So we now go to our computation. I explained the basis period now. This is the basis period. So let's now go to our computation. Let's see how it's going to be. So in our computation, you remember, we've talked about this basis period before now. We said when the company commences operation is going to be from the date of commencement to the end of the first accounting year, which is 30/9/2018. And when you look at this basis period 2, that is from the date of commencement, from 1/8/2018 to this date is 14 months. August, September, October, November, December, January, February, March, April, May, June, July, August, September. That is 14 months, all in all. But out of the 14 months, we need 2 months. That is, we need from 1/8/2018 to 30/9/2018. That will be 2 months. So we say 2/14 multiplied by the loss. We have this. In this same year, we have capital allowance of 250. We bring the capital allowance in. We don't need it for now. We cannot relieve it. We still have loss. In the second year, it's going to be from the date of commencement. Sorry, from a day immediately after the end of the first accounting year, and that is a day after this date, which is 1/10/2018 to 30/9/2019. If you go there again, you notice that this period covers it. Maybe we can see 2018 rather, to 30/9/2019 in this period, which is 1/10/2018 to 30/9/2019. So, but we have a loss that we are bringing forward, which is 271. We bring it forward. The current year is 12/14. 12/14, we have 1.6. If you add the two together, you have the 1.9. Capital allowance, we bring that other one forward. And for the year, we have 125,000. So total capital allowance that we have now is 375,000. Now, in the following year, we had a profit of 1.2 million. Look at it. We have a profit of 1.2 million, 1.250. But don't forget that we have a loss of 1.9. So the loss will be relieved first. We have relieved the loss from the profits. So there will be new profits. Capital allowance, we bring the other one forward to the current year, and we add the current year capital allowance, which is 110. Which is 110 that we have here, we add it together. The cost loss as priority over capital allowance, we will not relieve the cook capital allowance now. We'll go to the next one, which is we have a profit of 725. But we have a capital allowance brought forward of 650. So the 650 will be removed or relieved against the profits. So we have new capital allowance. We are not carrying any capital allowance forward again. Sorry, loss forward again. But we have capital allowance that we are bringing forward from the prior period, which is 485. 485. For the current period, we have 124. So we bring in the 124. But don't forget that I told you that when you have capital allowance to relieve and loss to relieve, you first take loss, and whatever balance that is left is what the capital allowance can take. So we can now take the balance. How do you get this for the 75? The 75 was gotten from 725 minus 650,000. That is the balance between this and this. We can actually take it for our capital allowance to relieve it from our capital allowance. So the balance we now have is 534, which should be carried forward. So that is that. Any question? So I want to go through the notes. I'll send notes to you guys. I still want to go through it. If you have any further question, apart from this explanation I've made today, do not hesitate to ask the question. All right.
Thank you, sir.
Good day to you guys.
Thank you.
All right, thank you for your time. I appreciate it.
All right.
Thank you, sir.
Thank you, sir.